All right, class, let's begin. Imagine you're holding a company's income statement. It looks simple enough, right? Revenue at the top, expenses in the middle, profit at the bottom. Think of it as the company's report card for the quarter or the year. It tells you a story of how much money it made and how much it spent. But like any story, sometimes the narrator isn't telling you the whole truth. They might be hiding certain details in the fine print or using clever language to make a bad situation look good. Our job today is to learn how to read between the lines and spot the red flags that suggest something is amiss. So, what is a red flag? It's a warning sign. It's a signal that something might be wrong and requires a closer look. It doesn't automatically mean the company is committing fraud, but it does mean you should be asking more questions. Think of yourself as a financial detective. The income statement is your primary piece of evidence. We are here to uncover that story. Our first red flag is revenue growth that seems too good to be true. When you see a company reporting explosive sales growth, especially when its competitors in the same industry are struggling or growing at a much slower pace, your detective senses should start tingling. Is this company run by geniuses who have discovered a revolutionary new product or business model? Perhaps. Or are they using accounting tricks to inflate sales numbers? True, sustainable growth is usually steady and aligns with industry trends. A sudden, massive spike in revenue that defies gravity warrants deep skepticism. For example, a company might be channel stuffing, shipping excessive product to its distributors, shipping excessive product to retailers, more than they can realistically sell. It records these shipments as sales, creating a temporary artificial boost. That unsold inventory will likely be returned in a future quarter, causing a sudden drop in revenue later. Another trick is recording revenue from long-term contracts all at once, instead of spreading it over the contract life. This pulls future revenue into the current period, making the present look fantastic at the expense of the future. Think about it like this. One student gets perfect scores on every test, while everyone else gets average grades. The teacher gets suspicious. The same logic applies to companies. So ask, is this revenue growth realistic and sustainable? Look at past performance, compare to direct competitors. Read the footnotes to understand revenue recognition policies. Now let's move down the income statement to our next red flag: profit margins that are unusually high or strangely stable. A company's profit margin, like its gross margin or operating margin, tells you how much profit it makes for every dollar of revenue. These margins are often dictated by the competitive landscape of the industry. For instance, grocery stores typically have very thin profit margins, while software companies tend to have much higher ones. A red flag appears when a company's margins are dramatically different from its competitors, or when they never seem to change, even when the industry is facing headwinds. Consider a company in a highly competitive industry, like retail, where price wars are common. If all of its competitors are reporting declining profit margins because they have to offer discounts to attract customers, but one company's margins remain perfectly stable or even increase, you should be suspicious. How are they managing this feat? It's possible they have a superior business model, but it's also possible they are manipulating their expense numbers. For instance, they might be improperly capitalizing costs, treating normal operating expenses as assets, to keep them off the income statement and artificially boost profits. One common shenanigan is to create cookie jar reserves. This is where a company overstates its expenses in a good year to create a reserve, and then dips into that cookie jar in a bad year by reversing those expenses to smooth out its earnings and make its margins look consistently good. Think of it as a student who always gets exactly a 92 on every single exam, no matter how easy or difficult the test is. It's an unusual pattern that suggests something other than pure academic performance is at play. Our next red flag involves a curious line item you might see toward the bottom of the income statement: the one-time gain. Companies sometimes sell off a piece of equipment, a factory, or even a whole division. The profit from that sale isn't part of their core day-to-day operations, so it's reported separately as a one-time or non-recurring gain. There's nothing inherently wrong with this. However, it becomes a red flag when a company seems to rely on these one-time events year after year to meet its profit targets. If a non-recurring item recurs, it's a sign of trouble. Imagine for a moment a company that consistently misses its earnings targets from its actual business operations. To close the gap, management might decide to sell a small piece of real estate or an investment they hold right at the end of the quarter. The gain from this sale is then used to pump up the net income, allowing them to announce that they beat expectations. Investors who only look at the bottom line number are fooled into thinking the core business is performing well, when in reality, its profits are being propped up by selling the furniture to pay the rent. These gains are often buried in a category called other income. When you see a large or growing amount of income listed here, your detective work must begin. While legitimate, these sources are not sustainable. Another significant red flag is the presence of large, unexplained swings between profits and losses, especially when the company's underlying operations appear to be stable. A business that sells a consistent product like bread, toothpaste, shouldn't see its profits swing wildly from a massive gain one quarter to a massive loss the next, unless something extraordinary has happened. When you see this kind of volatility without a clear explanation, like a major product recall, a factory shutdown, it suggests that accounting choices, not business operations, are driving the results. This is a classic sign of earnings manipulation. One area to watch closely is depreciation. Depreciation is an accounting method used to allocate the cost of a physical asset over its useful life, like a machine, a building. It's a non-cash expense that reduces reported profits. A red flag appears when a company's depreciation expense changes dramatically without a corresponding change in its capital expenditures. For example, if a company suddenly reduces its annual depreciation expense, it will instantly boost its pre-tax profits. This could be a sign of a big bath restructuring. This is where a company, often in a bad year when new management takes over, decides to write down the value of its assets all at once. This creates a huge one-time loss. The benefit? It lowers the asset base. Future depreciation expenses will be much smaller, making it easier to show profit growth in the following years. Finally, look for a mismatch between debt and interest expense. If a company reports a large amount of debt on its balance sheet but shows very little interest expense on its income statement, something is wrong. Could mean there is off-balance sheet debt that the company is trying to hide. As we conclude our investigation, let's summarize the key red flags we've learned to spot. Think of this as your detective's checklist for reviewing any income statement. First, be wary of explosive revenue growth that significantly outpaces the industry. It could be fueled by unsustainable tricks like channel stuffing. Second, question profit margins that are unusually high, unusually low, or unnaturally stable compared to peers. Third, scrutinize recurring one-time gains and large amounts of other income. These can be signs the company is selling assets to meet profit targets. Fourth, look out for large swings between profits and losses that don't align with the company's operational reality. Fifth, analyze depreciation patterns. A sudden drop in depreciation, a sudden spike in depreciation. Sixth, check for a mismatch between debt levels on the balance sheet and interest expense on the income statement. This can reveal hidden debt or improper cost capitalization. Remember, the numbers on an income statement are the product of numerous estimates, judgments, and accounting choices. While most companies strive for accuracy, pressure to meet Wall Street expectations can lead some managers down a dangerous path of financial shenanigans. By using this checklist, you move beyond being a passive reader of financial statements and become an active, critical analyst. You empower yourself to look past the headline numbers and understand the real story of a company's financial health.